Hey everyone, so in this video I want to share with you a rarely used property valuation tool to allow you to fundamentally determine whether a large property market is overvalued or undervalued, and to hopefully help you improve your property investment returns. Then later in this video I'll use this tool to have a look at a couple of the major property markets around the world and how they've performed over the last few years. So the valuation method that I'm talking about today is when you compare the total value of residential property in a country and compare it to its GDP. So the total value of a residential property market is just essentially you add up the values of all the property that people live in within an economy and compare that to the income or the productive capacity or the wealth generation of that economy. So why this property valuation tool is useful is because if you look at GDP as people's incomes or a nation's income, the higher percentage of the income that they allocate towards housing, particularly just regular residential housing, is reflective of, I guess, the proportion of their income that they're willing to dedicate to that asset class. And the more that people put into housing, the less money there is to spend on other investments or consumptions within the economy. So as that ratio becomes larger and larger, that means there's less and less for the rest of the economy, and if you have a slowdown in consumption or investment, inevitably that's going to lead to slower GDP growth over time and slower incomes over time. And property typically correlates quite well with incomes over time, particularly residential property. So if you look through history at major markets, typically once total residential property values have gone up above 250% of GDP, prices aren't maintained at that level for very long, in that typically there is either an economic slowdown or usually both an economic slowdown and property falls in time, or currency depreciations to adjust for too much money being put into the property market. And the big reason why property is, you don't want your property market to be too overvalued, is because residential property in particular is a non-productive asset, in the sense that it doesn't produce cash flow or doesn't produce, well, it produces shelter, but because the owners of the property are living in that asset, it's not actually producing cash flow for the owner, so it's not really an investment, it's just it's consumption. And as we all know, we can't live beyond our means, so inevitably we can't overreach when it comes to spending on things that are consumptive items. So yeah, there is a limitation to how much of an income people are able to, or a society is able to dedicate to something that is non-productive. If you look through history, a typical ratio is normally between about 100% to 200%, and usually between about 120 to 180%. This is a more sustainable level of income allocation towards residential property. The benefit of using a ratio like this is that it adjusts for the economy that it's being used for, in the sense that if working population increases, that'll increase the GDP of that area, and as a result likely increase property prices and the need for property if the population is increasing. In addition to that, it can adjust for things like currency, or if there's an income growth in an area or productivity growth in an area, that will affect and improve GDP, which will also drag property prices higher over time. So as I mentioned previously, you'll often find that property prices will increase as incomes increase, or the GDP or the productive capacity of an area increases, and that'll hold true around the world, whether that's a mining town in Australia that's going through a boom, or Silicon Valley in California, or whether that's a financial hub like London. When things go well, property prices tend to go with it, or when incomes improve, property prices tend to go with it. So I've added a chart to represent this over the last 20-30 years in various countries like Japan, Ireland, UK and the USA. You can see that they've had periods where, or they had a period where most of these nations were sitting in between that 100 to 200% GDP, and then they accelerated up into the 250 to about 380% for the various nations, but they weren't maintained in those areas that sort of level for very long before they contracted back down to normal levels of 150 to 200%. And as you can see in the chart, these property valuations can peak and trend at different times, which is a lot more to do with the local domestic economy and and how that's going, how the incomes of that nation is going. So you can see in Japan's case that they peaked in 1990 at about 380%. And if you look at the Japanese prices today, they're still below where they were in the 1990s in Japanese yen terms, as they fell from 380% all the way down to 150 to 200%, back to more normal levels. So the best way to use this tool is to try and look for property markets where the house price to GDP ratio or the income of the area is below 175%, and preferably in areas where the income is growing or likely to grow soon. So when you're looking to see if GDP will grow in an area or incomes will grow in an area, you're really looking to see if there's new investment taking place or new startups happening, like a new factory or a new mine or new companies setting up or new industries getting established in a region. They're the sort of things that will promote growth and investment and over time increase incomes in an area and drag property prices with them. So the key takeaway from this video is that property prices don't always go up, and there are periods and times where they get overvalued and need to correct quite markedly. So you want to be looking to buy well and buy in areas where there's stable income or stable income growth or prospects for income growth. Well, thanks for watching. Be sure to subscribe to this channel, and I'll do up more videos to better explain property valuations and what moves property prices over time and how you can better improve your property investments. Alright, look forward to seeing you in the next video. Share this if you've enjoyed it. And just a little postscript to this video is I have intentionally left out comments and the stats around the Australian property market because I believe that deserves a video in and of itself. So be sure to subscribe if you want to see that, or share this video with your friends if you think they'll be interested in seeing that as well.